Good morning or good afternoon, depending on where you're located. And welcome to our webinar, ERM Implementation, a Primer to a Five-Step Process. My name is Jeff Rigsby. I'm the President and CEO of CB Resource, and I will be presenting today's session. First, I do want to take this opportunity to thank all of you for taking time out of your busy schedule to join me. I know that's not always easy to do. In our invitation, I believe we said this will run about 45 minutes, and I certainly intend to stay on schedule. For those of you that may not be familiar with CB Resource, we are based in Irvine, California, and we're a member of the Finance 500 group, a full-service broker-dealer. Through common ownership, CB Resource and Finance 500 joined forces to serve the funding, risk, and performance management needs of community banks across the country. Our combined companies provide enterprise risk management solutions, strategic and capital planning, wholesale funding, and investment banking solutions to over 2,000 banks. So with that, let's go ahead and get started. Or I should say before we get started, just to assist you in getting the most out of the webinar, just want to draw your attention. There is an instant messaging capability. If you want to post a question during the course of the session, feel free to do so. But we also will have a Q&A at the conclusion of today's session. Today's session is available to you. All you need to do is send us an email or contact us directly through Zoom, or feel free to give us a call. There will also be a recorded version available. So what are we going to cover today? I do want to just briefly talk about ERM. Want to talk about why ERM. We'll get into the model. Then we'll talk about those 5 steps. What does that implementation look like? From there, I have some closing thoughts, and then we'll move into questions and answers. So when we think about what is ERM, ERM's actually rooted in COSO, and it was first hit the scene back in 2004, and it was introduced as a comprehensive approach to looking at the organization holistically and integrating enterprise risk management across functional disciplines as well as operational areas of the organization. So if you look at it to the left, that was the original kind of Rubik's Cube view of COSO, and it laid out the framework. It always did come across as it was a discipline affected by the entity's board. It was set to establish strategy and designed to identify potential events that may affect the entity and manage risk within the organization's risk appetite to provide reasonable assurance that the achievement of the entity's objectives were completed. And then in 2017, they revisited it, and I like to think they kind of moved towards what we view as the purpose of enterprise risk management. And that really just comes down to it includes the culture, the capabilities, and practices integrated in strategy setting and performance that organizations rely on to manage risk in creating, preserving, and realizing value. So really what they did is they shift to this holistic view, if you will, of really enterprise risk serves driving performance. And I think you'll find it's about driving performance in good times and bad. So with that, I would like to mention that we are going to be talking about ERM or enterprise risk management from a top-down versus a bottoms-up solution. So for those of you that may or may not be aware of the frameworks or the disciplines, there is a top-down version to ERM, and there is a bottoms-up version of ERM. This small table happens to be something that McKinsey put together to kind of illustrate and describe the difference of the two. And as I mentioned, we'll be talking about a top-down version. That's our primary mechanism or vehicle, if you will. But a top-down version, just in short, enables top management to make better risk-based decisions. That's its intent. When you look at a bottoms-up, it drives a robust risk management system across the enterprise that allows more stakeholders, more folks in the organization to provide input. And what I would say is probably on a more granular basis and serves more as an audit function, testing processes and policies and controls. But as you see in what we're summarizing here, a top-down, the key benefit says the risk analysis does tie back to performance in franchise value. It does tend to focus more on major potential risk or emerging risk or threats. It does view top risk in a finite mechanism, like what are the organization's top 3, 4, or 5 risks? It looks at big things, but it does provide very effective oversight across the bank through multiple disciplines. And it does serve as an effective tool, particularly if you're a chief risk officer. It does serve as an effective tool to facilitate a discussion with senior management and your board about the risk-based areas of focus that you're responsible for. Bottoms up tends to be, as I mentioned earlier, it's extensive risk identification and analysis. It involves pretty much the overall enterprise. It tends to be a robust technology-based system. It could have as many as 7 to 10,000 risk attributes that it's measuring. And it does provide an effective and efficient way of measuring risk across the enterprise. Again, it tends to be more granular, control-oriented, top-down, probably more strategic, integrates performance. In either case, both systems are used independently by organizations, but there are organizations that also integrate both. We certainly have clients that rely on our system entirely, but we also have clients that utilize our tool as well as a bottoms-up approach. Just really quickly as to why some of the key reasons, we talked about ERM is about managing risk and creating, preserving, and realizing value according to COSO. But when you think about some of the key benefits that come out of it for the organization, when it's working at its best, it really should support better strategic achievement as far as hitting your goals and objectives. It should help you elevate your execution level. It should enhance your ability to make really fact-based decisions. It should be a mechanism that elevates your risk awareness across the enterprise. Many of us are kind of been brought up in being risk aware from a credit perspective. ERM facilitates that ability to be risk aware across multiple disciplines. If it's working, it should reduce operational surprises and losses because it is about being forward-looking. It should prepare your organization to take the level of risk you're willing to take based on your risk appetite. It should ensure better execution. If we take a look back at the pandemic, I mean, we really saw business continuity plans kick in, which is another form of an element of enterprise risk management, but in anticipation of something that could pose an imminent threat or risk. Last couple of things are, it should actually help you optimize the utilization of your capital, and it should also break down functional silos. It should be a system that allows you to collaborate and share information more effectively across the enterprise. When we think about the model itself, so if you look at that green column, and I'm kind of laying this out to illustrate also the kind of the 5 steps we'll be covering. But if you think about it, whether you're going top down, bottoms up, all ERM systems, minimal standard is it should provide a process or a framework to identify, measure, monitor, and control risk. That's what systems are designed to do. That's what your regulators expect it to do. And so that's certainly something to be sensitive to as we go through the balance of our discussion this afternoon. But let's talk a little bit about it in context of the 5 steps as a flyover. That green bar really reflects a top-down approach, because what a top-down approach does, first and foremost, it links enterprise risk management to your strategic intent. In other words, everybody's strategy is a little different. Everybody's risk appetite is a little different. And some organizations are willing to take greater risks than others, and that's usually explicitly called out in your strategic plan. So if you think about a top-down in that first step we'll get into, it is about aligning your strategy with your system, or aligning your ERM system with strategy. It's also the first step where we get into enterprise risk, into risk appetite. And so we think at the tip of the spear that risk appetite needs to occur, because once you calibrate what level of risk you're willing to take or not take, it allows you to set the table more effectively for your enterprise risk assessment system, which kicks into step 2, identifying risk. Let's go. It is about conducting a robust enterprise risk assessment that articulates or calls out your inherent risk, your adequacy of risk management, the residual or composite risk that remains, and the overall direction of risk. And it should be by multiple areas. And depending on the framework you adopt, it could be by key risk categories, You could follow OCC's framework, you can follow FRB's framework, you can use CAMEL's, but it is about assessing those 4 key elements: inherent risk, adequacy, risk management, residual, and direction in a disciplined format. And again, I'm not here to propose any one system is better than the other, but these frameworks will work. If you are driven to do this all internally on your own, these are kind of the key considerations you want to embrace. As we roll into step 3, that's really what we would characterize as top risk identification, or in this case, measuring risk, where we want to, as you go through that enterprise risk assessment process, your emerging risk and threats should emerge. And as they emerge, they should be sorted, identified, and force ranked, if you will, by their impact to the organization, and further assessed to make sure that the controls are adequate for the level of risk you face. From there, you go into monitoring risk, right? Who gets what and when? And then that 5th step is, how do we manage it? How do we use the system to control our risk and to optimize our performance or create that greater value? And if you think about it, this is an infinite loop. And as you can see, it just continues to be a circular process. And as you implement it over time, it gets better and better. And so just in summary on this, think about the first 3 steps as your annual cyclical process. That's what you do. Identify, validate your risk appetite, conduct your risk assessment, identify and mitigate top risk. Those are the disciplines. Your monitoring system's accuracy and how you use it to make better decisions is all about measuring and monitoring the movement of risk over time. Okay. So let's go ahead and dive into the 5 steps. So first, we talked about the tip of the spear is risk appetite. And just to remind everyone, risk appetite is the level of risk your bank is prepared to accept to achieve your financial goals and objectives. I mean, that's what risk appetite is. If you have a strategic plan and it doesn't say risk appetite in it, believe me, either explicitly or implicitly, your bank your plan indicates what level of risk you're willing to take. And if you think about risk appetite, it really sets a clear strategic direction, and it certainly sets your tolerances and what you're willing to do in the pursuit of optimizing earnings and leveraging capital and creating greater shareholder value. And as I mentioned, your risk appetite also kind of serves as a blueprint to calibrate your risk assessment appropriately. Risk appetite is done. Some organizations have one risk appetite that is all-encompassing risk appetite statement. Others do it by different frameworks, right? And what we'll be talking about is a key risk category framework. But as you can see to the right, this indicates what our risk appetite is from a credit risk standpoint, from an interest rate risk standpoint, liquidity, operational risk, compliance risk, strategic risk, reputation risk. You can include IT IT or cyber risk. If you have operating functional groups like mortgage, like trust, like insurance, if you're more advanced and you're getting involved into what I might characterize as fintech types of relationships that could get you into payment rails, cryptocurrencies, cannabis, all of these various areas where risk resides may end up being considered a key risk category. So when you enter this first step, so let's think about it. So step 1, you're now about to establish and develop your bank's risk appetite. And when we look at step 1, we think it includes 3 things. It includes your risk appetite framework, which is the heat map. It includes your risk appetite statements, which is the definition of the level of risk you're willing to take, right? So my credit risk appetite is moderate because I have an above average appetite for growth. I am willing to run higher levels of concentrations to meet my goals. I am willing to serve higher risk customers. Whatever those conditions are, the risk appetite statement should call that out. And it should also be a summary of some of your key controls. But when you think about going through this risk appetite exercise, if you can involve your board, it's optimal because management might develop the strategy. The board certainly approves it. And so they should have something to say about what your appetite for risk is, right? And typically you form a committee to do these types of things. But what I would suggest is you adopt a category. We'll get into this a little bit more in a second, but adopt your framework, right? So if you're going to go with key risk categories, great. If you're going to use CAMEL's, great. If you're going to use FRB's framework or OCC's framework, I kind of like the regulatory frameworks because it makes the process more efficient. But go ahead and have a discussion and establish frameworks to say, so if I'm looking at credit risk, what are some of my key risk categories? Well, I'm going to consider growth. I'm going to consider the character of my customers. I'm going to consider the complexity of my product mix. I'm going to consider my delivery channels. I'm going to consider my utilization of technology. I'm going to consider the markets I serve. All of those factors go into the level of risk we're willing to take or not take, right? And you can apply that same discipline to think about operational risk. Think about, transaction levels. Think about your branch system, your automation, your remote capture, your mobile banking, other digital delivery systems, things of that nature. So you really want to consider all of the things you're doing to execute your strategy and what level of risk you're willing to take. And then lastly, just is to determine, once you've got your heat map, you have your risk appetite statements, you really want to have something that looks like this table to the right, which is identifying key risk indicators or key performance indicators that indicate what your risk tolerance levels are. And so develop a handful. You don't have to have a ton of them, but you do want to establish key risk indicators, key performance indicators, and what you would identify is the range of risk you're willing to take from low to high. And then that's your mechanism so that over time you can actually track the movement of risk across those risk tolerance levels, indicating how your risk is measuring up vis-a-vis your risk appetite. So that's kind of risk appetite. Step one. Step two, it's really conducting that enterprise risk assessment. So let's step back for a minute and talk about how you're going to do that. And risk assessments tend to be qualitative in nature, right? You're asking a series of questions, and you want to indicate what your inherent risk levels are from low to high. You want to indicate your control systems from weak to strong. You want to see what the aggregate or residual risk is. You want to take a look at the direction of risk. But what's really important at the tip of again, starting out when you're developing your enterprise risk assessment, adopt a framework. And that's going to come out of your risk appetite statement, right? Because you want your risk appetite framework to synchronize with your risk assessment. So if this is my risk appetite, and this is my profile. So that's the relationship between the two. So it's really important that you adopt that framework and stick with it throughout the process. Also, at this point in time, you assign or nominate risk owners. So credit risk might be your CCO, and interest rate risk, liquidity risk could be your CFO. Operational risk can be your COO or banking ops person. Compliance could be your chief compliance officer, things of that nature. Strategic and reputation risk might even be your president or CEO. Right? You want to assign your risk owners. And as I mentioned, if you think about it from a regulatory standpoint, if you happen to adopt a model that's consistent with the lens your regulators like to look through, you're creating kind of an optimally efficient system. And just remember, in terms of, if you can develop a process that looks at the qualitative, and this is an example of it by risk category, but you also want to be able to tie it back to those key performance and key risk indicators, so you can take a look at the quantitative movement of risk in your risk assessment process. You also want it to drill down deeper, right? So if you think about this as a dashboard, credit risk can have multiple subsections. Interest rate risk may have multiple subsections. Certainly operational risk does. Compliance, for example, in compliance, you're going to be looking at entity level risk. You're going to look at your CMS system. You're going to look at BSA AML OFAC. You're going to look at fair lending, consumer lending, deposits, abusive and deceptive practices, and how you're complying with multiple regulations, if you will. So as you think of this hierarchy, you want to develop that framework. You want to develop those subsections, and then initiate the enterprise risk assessment process itself. And that is typically, each risk owner may own it. And I want to step back and make one comment. When you think about risk appetite, I may have glazed over this, that's a team sport. Even though you might be in charge of credit, you might be in charge of finance, you might be in charge of ops, risk appetite is an opportunity to get together as a senior team and collaborate and elevate everybody's understanding of what risk is in each of these key areas. So if you think of risk appetite is a team sport, the risk assessment itself is really more owned by each risk owner along in collaboration with your chief risk officer or designee. And you want to go ahead and initiate that risk assessment process. And even from a top-down standpoint, you do want to get a little granular. You do want to dissect each of those key risk conditions that you're looking at in credit risk, interest rate risk, liquidity risk, op risk. And those are readily available. Heck, you can download OCC's Community Bank Handbook Risk Assessment, and they have something there called the RAS Risk Assessment System, and it certainly has their framework for conducting these things. We would certainly like to think you'd come to firms like us, but you can actually do it yourself. Now, one thing I'm going to mention to you that we do that others don't is most assessments will measure inherent risk and on a low to high basis, and they'll measure adequacy of risk management, which will result in a residual number and even direction. What a lot of assessments do not do that we are an advocate of is at the moment in time that you're conducting the risk assessment that you measure direction of that risk. We're not looking at direction from assessment period to assessment period. We want to look at this moment in time, what does my risk look like? If you're doing an operations risk assessment, everything's running in kind of a hunky-dory fashion, but you've got a systems conversion coming up in Q4. You cannot tell me that the current risk environment is stable. Your current risk environment is increasing because operationally you've got a conversion coming up, and that elevates your risk. So as you develop your own system, make sure as you're conducting these risk assessments, it's not good enough just to say what your risk is today. You have to answer that question. What do you think it looks like going forward? And again, that's reinforcing the discipline of what ERM is all about. It should be a forward-looking system. And so I just want to bring that out. That's not a common attribute in a lot of assessments, but if you think about it, if you're looking at any key risk attribute, you should be answering the question at that moment in time where you think it's going. This is a footnote, and this has nothing to do with assessment data, right? This has everything to do with the forward-looking. You really should be looking for external analysis that tells you where things are moving. Whether you're looking at economic analysis provided by UCLA or Moody's or whomever, but you want to take a look and incorporate in your risk assessment what the national, state, and local economic things look like, right? Where's the world going? We're in this prolonged low interest rate environment. We're in this excess liquidity environment. Quick data point. I think you all know we're in this excess liquidity standpoint. You may or may not know the magnitude of it, but if you take a look at the previous 6 quarters, or I'll say 5, if you go back to Q1 of 2020 to Q1 of 2021, if you take out PPP and look at how the industry's been doing, the industry's actually down in loans about 200 billion in loans. At the same period of time, we're up 4.2 trillion in deposits. So whether it's ERM or any risk assessment, think about the consequences of having a ton of inventory, our deposits, with minimal or less than an amount of demand that allows us to deploy that excess liquidity. That's something that your risk assessment may not ask the question of, but you need to know, right? So engage in pulling in information that gives you a forward look on what's going on in your markets, what's going on in the economy, what's going on in sector by sector activity. Try to gauge where things are moving as you're going through your enterprise risk assessment as it relates to each one of those key risk categories. And each one might be a little different. If you own cyber, for example, right now, you own IT, if you're the chief security officer or the chief information officer, and all of a sudden you're hit with the pandemic, and all of a sudden we have half our workforce that is working remotely. Is our assessment picking up the likelihood of these things? Or is it, now that we may be in an elevated remote workforce environment, where's that being picked up? Where is the analysis, and what system for enterprise purposes does the board need to know you're assessing these things? Do your regulators need to know? So when you think about all of these key factors to consider, it may not be just a statement in an assessment, it may include forward-looking data. Okay, so that's step 2 of the process. Step 3, top risks. So risk appetite, boom, set the table, there's our framework. We now understand what we're willing to do and not do. Step 2, we've conducted our enterprise risk assessment. From that, we asked ourselves a series of risk relevant statements or questions, and they rolled up to subcategories that rolled up to key risk categories. And somewhere in that risk assessment, things started to percolate up that told you where your emerging risks or unfavorable risk factors might be. An unfavorable factor could just be something's broken. Could just mean that you got cited with some BSA issues. It could mean that you've got to do something related to succession. It could mean that your concentrations are getting away from you. It could mean that some other policy is not working. So that's an unfavorable factor. So that could be a top risk. But other top risks could just be things that are coming up. Top risk could be good things. Top risk could be, hey, I'm launching a new product in Q4 of 2021. I'm doing a systems conversion in Q1 of 2022. I've acquired a bank. Any of these factors would represent a top risk, right? So hopefully those percolate out of your enterprise risk assessment system. And as they percolate up, they help you identify, okay, this is an emerging risk or threat. What's the magnitude of it? So really what you want to do, once you have those, you want to apply some discipline about what risk is higher than the other, or what risk is more significant than the other. Once you force rank those, you want to go through some sort of simple exercise that asks the question. You can see these are kind of standard top risks of most banks. Cyber risk, right? A breach, or maybe ransomware impact. Adverse impact to earnings due to fraud or loss due to elevated ACH or wire transfer activity. These are real life conditions, right? Adverse impact to earnings and capital due to economic downturn resulting in a weakening portfolio or performance, or it could be some post-pandemic condition. It could be all of your good people are being recruited away from you because some bank in some other state has now moved their credit admin to a totally virtual environment and they're recruiting processors from across the country. Whatever these top risks are, identify them. Once they're identified, ask the question, what's the likelihood of that risk occurring, and measure its likelihood. If it were to occur, how severe? You know, top down, we want to know where the inherent risk resides of a top risk. In what areas it reside in the credit area? Is it financial, ops, compliance? Could it be in a subdivision of the organization? Could it be in our factoring department? But where does that risk reside inherently? Summarize your controls, grade your controls. If that residual risk is higher than you want it to be to sleep at night, then nominate mitigating actions. We talked about who does these types of things. In a top-down process, risk appetite, team sport, enterprise risk assessment, individual application at the risk key risk category area. Top risk process, bring the team back together. This is something the executive team should be getting around the table and going over what the top risks of the bank are. And think about this process we've just conducted. If you do this at the earlier part of the year, how effective is this as a tool as you roll into strategic planning? You've identified everything that's going on. Your risk appetite says what you're willing to do or not do to make money. Your enterprise risk assessment kind of gives you a state of the union of your control systems. Your top risks actually identify either favorable or potential adverse conditions that need to be addressed, and take this data into strategy, right? So, and if you identify those top risks that need some correction, then those should drop into a risk mitigation plan where you've got that top risk, assign an owner, an accountable party, and then list out what you're going to do about it over time and track it, close those gaps, right? And if you see about everything we're doing, it kind of leads into an effective reporting. But as I mentioned at the outset, this is a 5-step process, but these first 3 steps we've talked about is really about a cyclical process that ensures you're doing these 3 disciplines on a routine basis, and you're basically operationalizing your ERM implementation process. Step 4, it's pretty straightforward. not every audience needs to see the same information. So first, when you get into monitoring, that 4th step, it's really answering the question, who gets what and when, right? It's what's the frequency of a report? What do we want each reader to have? So if we're talking about the board, well, we should probably make sure we at least talk about our top risks. We should probably summarize what we believe our emerging risks and threats are. There should be something in that dashboard that indicates the movement of risk. And there might be some other current factors. You can also use the board report summary to maybe talk about key themes or key risks that are going on that you think you need to expand on what they need to know, right? Next one is senior team, management. It's going to be a little deeper, right? A little more detail, a little more analytics, a little more about the key actions about risk mitigation and the status of that mitigation and perhaps where things are going. So management's probably going to have a little more. And then there's the committee. So if you formed your ERM committee, the committee kind of owns the deck. If you're a CRO, this is kind of your data dump, right? So this is everything that has to do with what's going on in ERM that starts just from the process we've been talking about all during this session on up to tracking and reporting. But remember, I mean, I'm going to reinforce as we go into reporting, those 3 steps we talked about is the implementation process. It's a cyclical nature of ERM to ensure we're calibrated appropriately and we're assessing the right things. Tracking and reporting is using other mechanisms to monitor the movement of risk, be it up or down. And so if we think about step 5, it's about setting up actionable intelligence. It's whether it's a dashboard, a series of reports, be it automated, be it Excel spreadsheets, be it some other form, but it's something that helps you communicate to management, to your committee, to your board, and even regulators, how you are monitoring the movement of risk. And I'll give you 5 key things you want to look at least at the board level. And I would say, even if you're talking to any regulator on a simple basis, and this is what I like about a top-down ERM system, is answer the question of what risk is moving in what direction. So in other words, think about 5 things, another 5-step process. Step 1 and 2 is risk going up anywhere? What risk is going up? Do I have some indicator on a report somewhere that gives me what risks are going up? Hey, that's number 1. Number 2, are there any risks that are going down? Do we have some favorable trends we want to monitor? That's good reporting, right? Risk going up, risk going down. I happen to like looking at capital in a regular monitoring system. So how is my capital adequacy holding up against my risk profile? Number 4, I want to just look at key risk categories and maybe a deeper dive in the themes. And number 5, I want to always look at top risks. So if you're providing your board or your management team, or even if you want to share something with your regulators during a review process, it's be able to answer those questions. What's going up risk-wise? What's going down risk-wise? What's the impact to the enterprise in any key area, particularly capital? Can I summarize my risk profile of movement in key risk categories? So if I have pages, do I have a strategic risk page? Do I have an operations risk dashboard? Can I drill down? I'll divert just as an example to make this point. Do I have a report that can give me an executive summary of something that's going on from an ERM standpoint that is going to make sense to the reader regardless of where they come from, be it management, be it the board, be it regulators, or other party that is assisting you in managing your risk from the enterprise level? And you can have movement of risk tracking. You can have a heat map that actually is tracking risk over time. There's different ways of doing that. You can set up variance reports. I don't know about you all, but a lot of times people that are monitoring the movement of risk don't really want to know how to build a watch. They want to know what time it is. So do you have a mechanism to monitor unfavorable trends, things of that nature? So seek a mechanism that allows you to take risk, take a look at your risk appetite, your risk profile, take a look at capital, have a dashboard for your key triggering events. Set up scorecards on each of your, this is a macro of the entire risk assessments across the enterprise. Have a dashboard for each key risk category. Pretty straightforward. Once it's set up, it should run normally. And lastly, have your top risk and your risk mitigation plan. So I did want to just share that it can be done, but to me, the secret of good ERM is creating outputs that can help make better decisions, can help respond to the movement of risk. And if it's really doing its stuff, it should help us identify emerging risk and threats so that we're best prepared and we're not taking ourselves out of rhythm through the process. So let's just sum it up. And when you think of these 5 steps, and again, I think if you're the chief risk officer at your bank, or if you're a bank that doesn't have a CRO and you're kind of the designated CRO, but you've been tasked with kind of setting up a committee structure, setting up a charter, and ultimately adopting a process, it's always nice to break it down into chunks. And so I just want to kind of close on that point is think about those 3 chunks first, right? Your risk appetite. It really indicates what level of risk you're willing to take or not take by key risk category. Some of that makes sense to you, and if it makes sense to your regulators and others, so much the better. Once you've continue to track and monitor what you're willing to do or not do to earn money, to create value, conduct a robust enterprise risk assessment that integrates data by key risk category, can roll up to provide a profile, can be both quantitative and qualitative, but really helps you understand across the enterprise what your current state looks like. That what is my risk profile as I conduct my risk assessment at this point in time. Through that process, you want to enter in that 3rd cyclical step. Out of my risk assessment, did any top risk, any emerging risk or threat, any unfavorable factor surface that I need to test further to ensure my controls are appropriate? And do I have a system in place to move those into a risk mitigation plan if necessary to ensure that the appropriate controls are being administered? Those are your first 3 steps. 4, make sure my tracking and reporting is where it needs to be. It should be robust in nature. It should be designed with the reader in mind. There's not one size fits all. It should be timely. I think minimally good ERM tracking and reporting is kind of a quarterly event. The committee might meet monthly, but it should be at least tracked, reported, and shared at committee level on no less than a quarterly basis. It should definitely be accurate, and it should serve better decision-making. And if that's in place, that should elevate your controls in the management of your ERM system, which provides, sound evaluation, being able to adapt your decisions to what the data sharing is telling you. Okay. So with all that said, my closing comment is this. The pandemic has probably changed the rules of engagement for us. It's changed the economic landscape. We now have all that stimulus out there that's changed our world. It's created this excess liquidity that we're dealing with. That perhaps it has prolonged low interest rate environment. It has affected sectors of our customers. If they're digitally or if they are a digital system, it's probably helped them. If they're not, like in retail or perhaps in other verticals like hospitality, it may have hurt them. But if anything, the pandemic has asked the question, do we have a discipline in place that helps us deal with adversity, uncertainty, and though it may not detect a black swan event, it's going to help you kind of read the tea leaves and ensure that you're asking the right questions about your risk on a routine basis and you're tracking the movement. That's kind of the key here. But whether it's the regulators driving you or it's a management-driven initiative, ERM can play a material role in how you identify, measure, monitor, and control your risk. And it's as important in good times and bad. And I'll share a quote with you. I was at a conference where it happened to be a McKinsey guy speaking. And he said, if all of you want to leave my session now and want my key takeaway about ERM, he says it's about 2 things. In the best of times, my foot is on the pedal. My indicators say go, go, go. In the best of times, I'm going after more than my fair share. And in the worst of times, I might be the first player that's kind of pulling their foot off the pedal a little bit because my indicators say I might need to do that. So think about it in those terms. In the best of times, get all you can. If those times are changing to be worst of times, be the first one to recognize it and respond appropriately. Okay. So with that, that is a summary of our 5-step process. Just before we get to Q&A, there is no such thing as a free lunch. This is our business. So I hope if you're looking to either adopt, upgrade, even change your current ERM system, please give us a call. I think you'll like it. We're modular based. It's a very disciplined approach, and it's a very sustainable and scalable approach. But we do have a fully integrated system. It's also modularized if you want to focus on risk appetite, if you want to focus just on an enterprise risk assessment, tie it back to your audit schedule, if you want to focus on governance or any other type of top risk analysis, it's a fully modularized system and integrated, and we think you'll like it. So with that, I will move to any questions that anyone might have. Okay. Obviously, I covered every imaginable point that you would ever want to know about with ERM. So with that, I want to take this opportunity to thank you all for taking time out of your busy schedule. If you're working with ERM, keep it up. It's like anything, it might be a little chunky, but it can be operationalized. It can change the dialogue in your bank. It can elevate risk awareness. It can help you actually elevate the level of risk you're willing to take if you want to make more money, if you want more than your fair share, if you want to move into a digital world. Having an internal framework that identifies, measures, monitors, and controls your risk, such as an effective ERM platform, I think is a non-negotiable. So with that, everyone have a great day. I hope you'll think of us. Remember that this session is available in both a presentation form as well as a recorded format. If that's something you would like to get a copy of for future use with your management team or your board or whomever, please feel free. Our contact information I will put up on our last slide here. By all means, you can reach Robert Finch, who can get you anything you need in support of your ERM solutions, or in this time of the year, strategic or capital planning as well. So I'll leave this screen up. Thank you all for taking time out of your busy schedule. I hope we have the opportunity to work with each and every one of you really soon. Thank you very much.